All right, Judd, we are going live.
Okay.
And we got one. We're getting people. All right. Everyone that's coming in the room right now, we will be starting at 6:30 on time. So I want to respect everybody's time. Currently, I have 6:29. We're going to start in 1 minute. For the ones that are already on, I want to go ahead. You probably see the calendar up. This is our next to last one, the business tax saving opportunities. We have one more left on December the 18th, tax implications on investments. We actually have a national speaker for that one. Her name is Amy Wall, so it would be a good one to join into. Judd, are you able to see my calendar up there?
I can, sir. I see it. You've got one highlighted, and we do have, of course, a date change from your original save the dates there to the 18th. And this is going to be a good one. We're going to recap the Roth IRA conversion, discounted Roth conversion strategy. And you've got some very interesting topics I am excited to hear about, and a great speaker.
A real good speaker, better than I am for sure. Anyway, we are at 6:30. So Judd, I'm going to stop sharing my screen. Everybody, most everyone here knows Judson G. He is the financial advisor for JHG. We do have an informal partnership and a lot of mutual clients. Today, he is going to be talking about saving opportunities for business owners. So Judd, I'm going to just have you take it over. Go ahead.
Thank you, Craig. I appreciate it. Yes, those of you may know me or may not. Judson G, certified estate planner. I have been in the business for going on 30 years now. JHG Financial is my firm. We've been here in Charlotte. I am a homegrown guy, been born and raised here in Charlotte. Craig, it sometimes feels like I'm definitely in the minority. But, you know, I got so lucky, as some of you may be as well, to have Craig as my personal CPA. If you've been on any other webinars, I like to describe him as the guru of tax advice. And I'm just so lucky to have him as my CPA and informal partner. Of course, being in the securities world, I do have to put up some disclosure. Presentation is for educational purposes only, not a recommendation to buy or sell. And of course, past performances may not be indicative of future results. I always like to start with a good quote, and I like this one a lot. Warren Buffett, as y'all might have heard, he lost his right-hand man last week, Charlie Munger, at 99 years of age. Warren Buffett, still around with us, older gentleman as well, said, "Do not save what is left after spending. Instead, spend what is left after saving." I think that's pretty good advice, don't you, Craig?
Yes, Judd, I do.
So kind of two different things that we're going to talk a little bit about today: business tax saving from a tax perspective, cash deployment opportunities, because up until recently, we haven't been able to get anything in our money markets. But that has changed, of course, and we'll talk a little bit about that. You know, I'm sorry about my camera, y'all. I just ordered a new one from Logitech today, but my camera is not down, but this picture is probably better anyway. So again, we're going to start with small business tax savings idea. And one of the things that we're going to go over today is what I like to call the best kept secret in the tax code. It's kind of really why Craig and I got together. And my operations manager, Bird, was actually in public relations before he started working with me. And some of the local media that I've been on talking about the Solo K, the Charlotte Observer, the Charlotte Business Journal. I was actually on CNBC about the Solo K, and the media, the journalist writes for Time Magazine. So I was also in Time Magazine as well. Happy to give you some of these articles. They are dated, but only the only difference is really the limitations on how much you can put in, or rather they've gone much farther up since these dates. Right here, I've got a 2023 retirement plan comparison chart. And I'll start kind of down at the beginning here. And most of my clients start out with what's called a simple IRA. A simple IRA, I like it a lot. And one of the reasons why is because there are no startup costs for a simple IRA. Also, there are not as many restrictions on it, such as testing. 401ks have to have testing. Certainly a cash balance plan is required to have that, but it's really a great plan. I think that folks can only start. One of the weird things about it, so to speak, is that you can only start one from January 1st to October 1st. So if you've waited until the end of the year to think about a retirement plan, unfortunately, this one is not going to be one for you. It's basically for startup companies, probably in their first to third years. Would you agree with that, Craig?
Yes, I do. I actually had a simple IRA at one time, Judd. The good thing about the simple IRA, it's the easiest thing. That's why it's called simple. What I enjoyed the most about it was easy to set up. Also, I chose, there's options, contribution options down. I chose option number 1 there when I did it. We matched 100% up to the 3% of employees' compensation. And the reason we chose that one is I did not have to match on the simple IRA if someone didn't have skin in the game. The second one, even if let's say Mary, Mary here decided not to participate, I had to still contribute 2% of my compensation to all eligible employees. So I chose, with the option they gave me, I chose that one. So when Mary didn't participate, I didn't have to do anything. Again, 3% isn't much. So you're right, Judd, this is where firms start out at. Now, Judd, obviously, because you set mine up, we're now on a 401k plan because we outgrew it. And yep. That's the great thing with the simple. It's easy to start, but at some point you're going to outgrow that plan. That plan is not going to have enough meat on the bone.
That's right. And one of the things sometimes that I do get a little bit of pushback on is that on the simple, you can see it has 100% vesting from day one. So whatever you match, that 3%, if that employee walks away, they do get to take that with you. And there is some incentives where you can do a vesting schedule on a traditional 401k plan. So anyway, that's one of the things that is interesting. Craig, I think you did mention something that was very interesting to me that might have come out with the new Secure Act, or maybe not. But you said there was some benefit on simple IRA, perhaps for educational purposes?
Well, we did talk about, this is a strategy that I just learned about. I don't know everything about tax and strategies, but one thing that I did learn you can do is, and we'll talk a little bit later about hiring your child. And I'm assuming this is what Judd's talking about. You can hire your child, or you can, and you could actually pay your child, and since your child is working for you, put the money, let them put money in a simple IRA. And there could be that there's no tax, a deduction for you, and then the simple IRA can be used for education purposes. You're still going to pay tax, just like on any IRA when you take the money out, if it's not a Roth, but there is no 10% penalty for education. Now, obviously, we have the 529 plan also, but the simple IRA allows usually for the parent to take the deduction while the kids pay no tax. And depending on the tax bracket while they're in college, they may not pay no tax on that money either if they only withdraw a certain amount, such as $10,000 a year.
Yep, that's exactly it, Craig. Thanks for reminding me. The other thing that's kind of a limitation on the simple is the amount of compensation one can put, or the max amount, and that's only $15,500 for this year, with the additional $3,500 for catch-up contributions for folks like Craig and myself that are over 50. So a lot less than the $22,500 on a pre-tax basis on the 401k over here, as well as a $7,500 catch-up for those over 50. So simple IRAs, I love them. I think they're great for someone to kind of really get their feet wet. And as human beings, I think we're creatures of habit. And one of the things that often I notice in my 30 years almost in the business is that we get into habits, and therefore, if you haven't started a retirement plan, this is an easy one to start. There's no startup cost. There's no testing. It's just a great plan to kind of get your feet off the ground, and then potentially can roll that money over if you outgrow it like Craig did and go into a 401k. Now, the next plan is the SEP IRA. And I really don't use those much anymore unless someone gets past the deadline. The one thing that I will say about the SEP is that if we've got a client that does have a need for the previous year, you are able to open that up anytime prior to your filing, such as March 15th, Craig, they could open up a SEP.
That is correct. And then also, you can also look at extensions, I believe, but I have to look that up. But yeah, definitely March 15th.
Yeah. The reason that I don't love these anymore is right here. This is the discretionary employee contribution. And as you can see, what it says is up to 25% of compensation. So let me give an example. Let's say that I had a salary for JHG Financial of $100,000, and I decided to put $25,000, which is 25% because I am incorporated. But what I would have to do is I would also, for every eligible employee, I would have to put 25% of their compensation. So if Craig worked for me and he made $100,000, then I would have to put 25,000 out of my own kitty, out of my own pocketbook, so to speak. And so it's not where the employee decides to make a pre-tax contribution. It's all about what the employer decides to do for themselves. It's really a profit sharing plan. Is that probably a good way to explain it, Craig?
That's a great way to explain it. Yes.
Yeah. And it has 100% vesting. It's very cost effective. There really aren't any setup costs, no administration, but people are really using my favorite plan mostly when they're looking at SEPs because of that reason I just mentioned. Now I'm going to skip over the solo K for now because I'm going to go over that in depth, Craig. Okay. I'm going to really kind of run over here to the 401k plan. And the 401k plan is what most of us are familiar with. That vernacular, that term, most of us have heard of it. In fact, most of us probably been in a 401k. At JHG Financial, a lot of my business comes from when someone leaves a company and they want to gain control of their assets, and we can do an IRA rollover. But I also do have multiple companies, including Craig's, that have a 401k. You have to set it up, of course, prior to the year end. If you haven't done so, you might be able to squeeze one in right now, but companies are very busy with these. And so they provide an effective tax tool and employee benefit for employers to really not only have some control, but to try to market themselves as a benefit. I think most companies that want to garner good employees are going to need to have probably two benefits these days, and that's health insurance and a retirement plan. So this is this is the right plan for you. Something that that came up many years ago, but we're still just seeing plans adopt, is the Roth component. In other words, if you've got younger employees, they might want to make after-tax contributions into a Roth, because Roth IRAs have limitations as well. So if you do have someone that's making over the limit to contribute to a Roth IRA, which I think this year, what is 160 or so, something like that, Craig?
Well, I can tell you what it is for 2022, because I obviously I'm always a year behind you. But for single, it starts phasing out at 129,000. Married filing jointly, it starts phasing out at 204. So by the time you make 215,000 married filing jointly, you can't put directly into a Roth.
And that new number, Craig, for this year is 138 for a single modified and 218 for married. So I got my handy dandy little chart right here. We're a good team.
You're always a year ahead of me. I'm just now getting into 2023.
You can put some eligibility requirements on a 401k that you can on some other ones. You could say that someone has to be 21 and have 1 year of service with 1,000 hours. That 1,000 hours is changing starting, is it next year, Craig, to 500?
Yeah, 500 average, yes.
Yep. But the nice thing is again, on a pre-tax basis, or if you want to do after tax in the Roth, you can put 100% up to 22,500 if you are under 50. And again, us older folks can do the catch-up contribution there, $7,500, which rounds us out to an even 30,000 this year. You can also do a profit sharing on a 401k. So usually I tell my clients, go ahead and add the profit sharing on. You don't have to use it, but if you have a really great year, you might want to get the third party administrator. That's one of the downsides of a 401k, is it does cost money to set it up. Typically somewhere around $1,000 to $1,500 a year. So you can do the one-time setup, and we will talk a little bit about some new Secure Act stuff in a moment. The tax benefits they're trying to let us have incentive to open up a 401k, because they know that Social Security may or may not be around, and so we better be saving for ourselves, right, Craig?
Well, yeah, you're going to see a little bit later on when you go over the credits. The IRS is going to incentivize you to open one up. Actually, they're going to pay for it, basically.
Yep.
The administrative costs.
Yep. So the vesting schedule is available. So you can say that, an employee must work for you for up to 4 or used to be even 6 years. We call that a cliff. So that's nice. So you can give some incentive maybe for the employee to stick around with you, because they're going to lose those matching dollars that you have put in the match. So a lot of times folks will do a match on this, meaning that a lot of companies these days are doing 50 cents on the dollar up to 6%. And what that is incentive for employees to help the company to be able to put more money in for the own employer to put the max in. And so again, if you think about that, if it's 50 cents on the dollar up to 6%, that's going to kind of incentivize the employee to do 6% in order to get that free money, as I like to say. So that's a little bit about the 401k. Any other thing, Craig, you want to say about that? Because I will cover the tax stuff.
I think we'll grab the solo K. The main thing I want everyone to understand is if you own a business, this is probably your number one tax advantage savings tool. It's dollar for dollar credit if you use the traditional side. Matter of fact, if anyone's interested in this chart, if you email me, this is a great little chart. It's got all the retirement plans on one page, and we're not going to go over all of them for time today, but you know, I even look at the cash balance plan. I mean, that is for some, you know, that works out really good if you have high income and maybe none or one employee. I've got one that has one employee, and you can put a lot of money away on that one. If you look down there at the bottom, how much you can put away, individual contribution limits up to $245,000. That's a big tax deduction. My point is, I just want you to know, if you own a company, you should have a retirement plan. I don't care if you're it's just you. I don't care if you got 20 employees. Most of my people are one owners, and that's why he's going to talk about solo K. But if anybody wants this chart, which is a very good chart to look at to decide where you want to start, email me. I'll get you this chart.
Yep.
Go ahead with the solo K there, Judd.
Sure. We did the safe harbor too for Craig. And again, we could talk a little bit about that. I won't go into detail on it at this moment. So I did mention that I was going to talk a little bit about the Secure Act 2.0, tax saving for employers. By the way, if anyone wants to go to jhgfinancial.com, jhgfinancial.com, I do podcasts, and one of my recent ones over the last 2 or 3 actually covered a lot of the Secure Act 2.0. But this is expanded credit for retirement plan administrative costs, and 3-year startup tax credit used to be 50%, but now Secure 2.0 increases this credit to 100% of qualified startup costs. So as I mentioned earlier, it may cost $1,000, $1,500 to set up a 401k and administer it. So this really will benefit you. As Craig mentioned, net, it's really free, isn't it, Craig?
Yeah, I mean, obviously I'm going to take advantage of the situation, and the government is going to help subsidize my administrative costs. And there's another little nugget in there, another little tax credit. If you will, there's an automatic sign up where basically an employee has to opt out. You know, there's an additional credit for that, Judd.
Oh, wow. Okay. Yeah, that's right.
There's an additional credit. So there's more credits to be had, but obviously the annual limit on this is $5,000. I'll go ahead and tell you, you won't, none of my clients, Judd, will get to the 5,000. I mean, I'll share mine. Mine's 2,500, and the IRS is going to pay for it. So thank you.
Well, I certainly hope that I'm not going to find a plan that's going to cost that much. But if it is, it's going to be a lot of employees.
That's correct.
Yep. So again, I call this the best kept secret in the tax code, and it is called the solo K, the individual K, the single K, but the IRS's name of it is really the super simplified 401k. And it is very specific because it it is really earmarked for a employer that doesn't have any employees, although it could be multiple business owners. But again, no full-time employees. That number moves down to a small number next year to 500 hours. So, you know, some people might think, oh, I've got a part-time employee, but they can get to that 1,000 hours very quickly. And certainly with 500, that's going to be tough.
Now,
They can also employ a spouse. A spouse can be a part of the plan. Also, I think, can children be a part of the plan as long as they're an adult, Craig, if you support them?
well, I think we run into an issue, Judd, with compliance there. The spouse coverage is an exception. You can hire your spouse and have your spouse work full time. I do think, Judd, that there's an issue with the children, though.
Okay. Yeah.
If you'll notice on there, your spouse coverage, that's the one exception
Yep.
to the no employee rule. You hired your child, sorry, too bad, so sad. And you're just not going to be able to qualify them as part of it. The spouse is the one you want to hire as far as this is concerned. Now, once again, you got to be careful if you want to hire your child. If you're an S corp owner, you need to talk to me individually how to do that. But then we're talking about hiring a child that's less than 18. Judd, they wouldn't probably have the 500 hours in, so that would not prohibit them from doing the solo K. I have people doing a solo K who do have their child hired, but they're less than the 500 hours.
Yeah. Yeah. Well, again, this plan is very narrowly focused. It is for the single, a great example are real estate agents. My wife is a real estate appraiser, and she has her own business and has for 25 years. And she maxes out her solo K every year. The great thing about it is the generous contribution limits. You could do up to 67,500 this year. That's a combination of the pre-tax and or the Roth, as well as, of course, you could do a catch-up contribution if you're over 50. And plus you have a profit sharing, which again is 25%, up to 25% if you're incorporated, of your compensation. So that's a really great way, folks, that if you might be a little bit behind the 8 ball on your retirement savings and you do qualify this plan, you could really put a lot of money into it. The other thing that, you could do is you can do rollovers into the plan. That's certainly eligible. So if you've got other retirement assets out there and you would like to consolidate those into one, you can certainly do that. So again, you can consolidate there. You can also, this is what really I think people really dig, and that is that people love to have access to their money. I know I do. And so this is the only retirement plan other than a 401k that has the ability to take out a loan. All right. And folks, because you are acting as the bank, there is no cost per se because you're paying the interest back to yourself. So that's really, people love that. And by the way, that is $50,000 or half of the account value, whichever is less. So I don't like people to take a loan off their 401k. These are earmarked for retirement. Unfortunately, Craig, the numbers say that over 60% of people in 401ks in America have loans on their 401k. And I would dare say some of them probably use something to buy a new car or go on a trip to Hawaii. That's not a good reason to take a loan in my mind.
No,
but it is there.
It's not. But Judd, I just had a phone call with someone today who's having a client who's having a lot of medical issues,
Yes.
a lot of medical issues, and outlook isn't bright, but they need money because they're not working, they're not making as much. we they were going to look at tapping in to 401k money, but I think they're going to do the loan at first, with the hopes that health gets better, income goes up, and they can escape tax, because the loan is not a tax unless you have separation from the company or something of that nature. But the solo K is great. And I think the most important thing, Judd, I know we've talked about administrative costs being $1,000, $2,000, all this. The administrative costs that I've seen in my years with the solo K is next to nothing. I mean, the setup fees minimal. I see some that are 0, some are 100. I mean, you would know more about the fees, but the fees are much less than a normal 401k.
Definitely. I'm glad you bring that up. It is there with one company that we use, it is $0, and the annual cost, I believe, is $30. Another that we use does have a setup fee that is, I believe, $100 or $125. Their ongoing administration is less than that. I think it's like 30 or 40 bucks a year. So that's a really great way for you to get a plan that'll allow you to put a lot of money in. As you can see this year, the limit for us older folks, again, 73.5 and 76.5 starting next year. So that's nice. And those are some changes, as you can see on some of those plans right there. But I just love the solo K. I think that is the way to go if you're eligible to have one.
I agree.
So that kind of wraps up a little bit on the tax saving opportunities. And the next component that we're going to talk about is cash deployment opportunities. I can't tell you how many times, I've got a strategy, Craig knows about it, that we use with all of our clients with JHG, and I call it vault loads of money. And so I like to look at my clients' money in vaults. Some people say buckets, but I like to say vaults because I also use it as vault M1, M2, M3, and M4. So our treasury calls money supply in America M1, M2, M3, and M4. So I want all of my clients, Craig, to have about 3 to 6 months worth of cash in their bank account, in their M1, in their bank, that does not fluctuate, that if we have a COVID come along and no one can work, or most of people couldn't, that you've got a backup. But once you get over, let's say that your monthly nut was $5,000. In that case, I would want you to have $15,000 up to $30,000, depending on your level of comfort, in your bank account. But I can't tell you how many times up until the last 9 months, clients would call me and say, "Hey, Judd, I've got that $15,000 or $30,000, but now I've got 50 or 60. And so, what do I do? Because the bank is paying me nothing." And that can be tough to find how we can beat inflation, normal inflation, and beat the bank. It used to be easy. Now banks are having to pay us a decent amount, but still, when you factor in inflation, it's not that much. So my question here is your bank offering the best yield on your cash balances? I do have some conservative ideas or options for folks. One is, higher yielding money markets. And my job is to try to make my clients' money work as hard as possible. If you're with a big bank these days, I think you're probably still lucky to get, 1%, 1.5%. If you're with a small bank, I have seen some offer up to 4%, and that's great. But, we currently have money markets offering yields more than 5%. One, which is in a government obligation money market, is offering 5.08%. And folks, you might think that I've had clients call me and say, "Hey, Judd, I'm now getting 4%. And I say to them, "Craig, look, That's great. If you've got 100,000, let's use some easy math, and you get 4%. At the end of the year, you've got $4,000 you've accumulated. Is that not correct, Craig?
That's correct.
But Craig, you know this better than anybody else. Who wants some of that back?
Uncle Sam in North Carolina. Most of my clients live in North Carolina, so the state's got their hand out too.
That's right. So those good old folks at the IRS want, let's call it 20%. And then the North Carolina Department of Revenue, those folks up in Raleigh, they want it, let's call it 5%. So if you got a 25% combined tax bracket, you're going to send $1,000 back to our favorite people. And that leaves you with 3,000. That still sounds real good. But if you think about it, currently, Craig, what do you think? What's our inflation rate running these days?
Oh, you're asking me a financial question, huh? But
it's 3.4. 3.4%.
Okay.
So what we have to do, folks, we have to do a little financial gymnastics here. We have to subtract for the invisible hand and go subtract $3,400 because gas is going up, houses are going up, cars going up, fees are going up, groceries are going up. We got to subtract 3,400 out of that 3,000. You are left with a negative 400. So it might sound great at 4%, but in a non-IRA, it's not that great. Another option that Craig and I really like are tax-free municipal bonds. All right, tax-free bond funds. So let's not mistake it. Yes, you can buy a bond issued by Mecklenburg County or Durham, the city of Durham, or the state of North Carolina, and that does have a finite years, like a 10-year bond, a 30-year bond. But what we're talking about is buying a portfolio of multiple, and we'll see in a moment when I pull up an example that you might have hundreds of bonds. Diversification. And if you are a North Carolina resident and you invest in a North Carolina tax-free municipal bond fund or exchange traded fund, which is what ETFs stand for, then it is 100% tax-free, both federal and state. Correct?
That is correct. That is correct.
And the average yield on a North Carolina bond fund right now is probably about 3.4. And so Craig might help us out with a tax equivalent yield in a moment. But real quick, there are other options such as equity income, things called real estate investment trust, REITs. They have great yields on them. When you walk into South Park Mall, that is Simon Properties. Their specialty is upscale malls across the country. REITs generally have dividend yields ranging from 5 to 8%. They're pretty conservative. Also, other fixed income solutions, senior floating rate funds, treasury bond laddered portfolios, different things of that nature. So let me go here.
Now, Judd, just to back, you stay right there, but I just want to tie something together real quick. I want to make sure that my clients understand what he's giving you different options where if you have cash, excessive cash. I know some of my business clients, Judd, have over $100,000 in their bank account. Some, don't have as much, but like Judd said, if you need 30,000 to be that takes care of you for 6 months, but you got 80,000, this is where you would take that 50 grand, that extra money, and you put into one of these vehicles that Judd's talking about, but it's pretty liquid. It's not as liquid as going down to the bank and getting your money out, but typically on most of these vehicles, Judd, if they needed their money, they could get it out 3 days. Is that a fair statement?
That is a very fair statement, Craig. I'm so glad I got you in my back pocket, so to speak, because sometimes I do forget things. And yeah, he's right. This is for businesses that have excessive cash buildup, and there is a rule
or personal people.
Or personal, absolutely. And so, you know, the SEC has what we call a 2-day settlement. So if you call me, you need some money, Judd, I need $10,000. My AC broke down. One of my trucks, delivery trucks broke down, whatever it is. Please give me 3 business days, because we will link up your business checking account with your investment account. So there's a free flow back and forth. It doesn't cost a dime to do what is called ACH. And so you call me up, I need 10,000, Judd, out of that 50 I put with you. We sell it, 2 days, it settles. And then on the 3rd day, you will see that show up in your bank account. Let me repeat this: business days, not weekends and not holidays. A client wondered where their money was last week, and I was like, honey, don't forget Thanksgiving's in there, and the banks aren't open, and neither are the markets, right? So 3 business days, but it's very liquid, extremely liquid. This is an example of a municipal bond fund. As you can see here, it has 621 bonds from different parts of the country. This is a national bond fund. It has an average duration of 7.56 years. What does that mean, Craig? That means that the average duration of those bonds is 7.56. That means it's fairly short in duration. Bonds can go out 30 years, but again, that doesn't matter to you because you have full liquidity, All right. You know, the Fed has raised interest rates 12 times. I'm an economist, Econ 101. When interest rates go up, bonds go down in price. That is correct. So bonds aren't like stocks based on supply and demand or the economy and how many iPhones Apple made sell more than they did last quarter. No, bonds are basically subject to interest rates. So we can see, because the Fed has raised rates a little bit this year, although we think they are stopping, they should be done. We'll know within a week or so if they are, but it is down a little bit this year, but very conservative. Oh, by the way, Craig, some people asked me, one of our clients asked me today, because we're going to put her mother into some of these. She said, Judd, how safe are these? And you know what? I said, if Mecklenburg County, the state of North Carolina, has a problem paying their debt service, their interest, what are they going to do to me and you, Craig, as residents of our counties that issues these bonds?
Well, Mecklenburg County, the counties are going to up your property taxes. And if the state needs to meet their bonds, they're going to up their income tax. They're going to get it from their citizens, and you're going to pay it.
Hey, Craig, I told her, I said, are you going to cross your arms and say, I ain't paying it? No, you are not, because there are for sure 2 things that happen in this world, and that's death and taxes. And so they are very conservative. I'm not saying that a county, a city has ever not gone out of business per se, but it's not even worth talking about. It's less than half of 1%. I don't think a state's ever gone insolvent, that's for sure. Because all they got to do is raise our taxes and we got to pay it. The current 30-day yield on this, folks, is 4.42. 4.42. And this is federally tax-free because this is a national municipal bond fund. So as I mentioned, there's a lot of different holdings in here through different states, 621. And so what that means is that because you're not paying the big part of the taxes, right, Craig? You're
Right.
going to pay more. So, Craig, you want to pull up a tax equivalent yield for us?
Yeah, we can do one. Let's see.
You want me to stop sharing so you get to full screen?
Yeah, go ahead. Let's see if I can Now, everybody, I am not the best drawer, so please bear with me. Would you like to use that 4.62%?
Yeah, 4.42.
4.42. Okay. So what he's talking about is this. I'm trying. That's a 2, y'all.
Looks good.
That can be 4.42%, sorry. It's the same as saying 0.0442. If you're, I'm taking them back to ninth grade math class.
Good, we need it.
So 4.42% could be written that way. Now, what we want to determine is, since we're not paying tax, if this was 4.42%, we had to pay tax, then Uncle Sam would take some, and unfortunately, we wouldn't end up with 4.42%. But what we're going to do is we're going to say that John has got into this bond. He's earning 4.42%. There's no tax, so we need to adjust and say, okay, since he's not paying no tax, what is it really yielding him since he's saving on the tax? Judd, you want to pick a tax bracket he's in? You want to go with 30% to keep the math easy? 40%?
Yeah, let's keep the math easy. Let's find out what that tax equivalent yield is with someone in the 30.
30. Okay. So what you do is basically you do the inverse. You will take 1 minus, Judd said 30%. Again, can be written as 0.30. It's the same as 30%. 1 minus 0.30 is 0.70 or 70%. Okay. So all we have to do is pull out our calculator and divide that. This is something y'all also know how to do, so you can, if you're doing these muni funds, you'll know. But 0.0442, and I'm doing it right now, divided by 0.7 is going to yield 0.0631, which in other words is 6.31%. So even though you think, oh, that's 4.42, money market's 5. No, money market you're getting taxed on. Here you're taking away, if you put the tax equivalent yield in there, it's yielding 6.31. That's the best way I can explain it, Judd. I don't know if that's the best, but that's what I got.
Hey man, that works good. I really like it. And your drawing skills are not that bad at all, sir.
I don't know about that, but
a lot better than what I thought. But nevertheless, are better than I could do for sure. But again, so I think this is a great example of what I like to put in kind of what I call the M2 bucket. M3, by the way, you're probably like, what's that, Judd? That's someone that comes to me and says, Judd, I've got a goal of buying a coastal house. Well, we can take a little bit more risk, try to grow that money at maybe an average of 5 to 6%. M4 would be like your Roth IRA, your solo K, your 401k. We want to be most aggressive in that. Certainly if you're not close to retirement anyway, and we want to try to grow those at market type returns between 8 and 10%. But this is a great example of something that, we think over time is hopefully going to average around, 3%. We've got a really bad year. By the way, folks, for the third time in history, the stock market and the bond market were down in the same year. That rarely has happened. That's gone all the way back to the 20s. And not only that, Craig, but the S&P was down 18.11. In the bond market, the Barclays Aggregate Bond Indice was down 13.4% because our wonderful folks had to chase what they called transitory inflation, which was not transitory. But thank God it's going down. But Craig, we're a little bit ahead of schedule here. But that's kind of all I've got for folks. If you want me to stop sharing, and if you want to talk about something else, I know you might add something else in your bag of tricks, or we could just let people go.
Well, real quick, Judd, first of all, thank you. I do think that the retirement piece in the beginning is very important to business owners. If you do not have a retirement plan set up through your business, you're missing out. You're missing out on humongous tax deductions. Judd knows. First thing I tell everyone is to max out their retirement before they do anything with Judd. He knows that because I believe that's the #1 vehicle that you should be using for tax mitigation. Also, you people that have additional money just sitting around, there are ways to get the yield of 6%, like we just showed you. So, if you have questions, please contact me on that. Judd, I appreciate it. I'm not going to keep them much longer, but I do want to mention a couple things that I do think is important. Number one, the most important thing I want to share with you, if I get my screen right, I've kind of talked about this before. I want to make sure everyone knows, because that starting January 1st, 2024, you're going to be required, if you have a business that is an LLC or an S Corp, you're going to be required to do this BOI reporting. I'm not going to go through all this again, but basically it's beneficial ownership information. If you own an LLC or a corporation, they want to know who you are, where you live. They want to have a picture ID of you on file. So most of my clients have to file. There's about 1 out of 100 that doesn't have to. I'm not going to, like I said, I'm going to go over this whole presentation again. I just need you to know that you need to file. We are going to be helping our clients this year, assisting with them to make sure that happens. Most importantly, if you don't want to file, that's fine. Right now, FinCEN, and by the way, this isn't the IRS, this is FinCEN. They show up with guns and handcuffs. The penalty is $500 per day, and there is no max. Wow. And then there's criminal. They can lock you up. So I want to make sure, and again, I'm not going through this whole slideshow. I want to make sure everyone is aware of BOI. You must report sometime between January 1st and December 31st, 2024. I was expecting them to put this on hold, and they still might, but it's December 5th, and as of today, it's still enacted in law. So I want to make sure everyone is aware of that, Judd. The only other things I had, we talked a little bit about hiring kids. I'm not going to dive into that much. Anybody has a child under 18 that is interested in the tax benefits of saving tax by hiring your child less than 18, please call my office. It's a great tax mitigation strategy. And then on top of that, you can save for your kids' education or retirement, and that money will never be taxed. I can show you how. Last but not least is SALT. That's a state and local tax workaround. You can have your partnership or S Corp pay for your personal state taxes. And the reason you want to do that is when you pay for it, there is no deduction. Your company pays for it, there is a deduction. So once again, if you owe the state every year, you may want to call up me and say, hey, Craig, if I'm going to pay the state, why don't I go ahead and get a deduction too? I can tell you how to do that. Other than that, Judd, I'm done. We've almost gone an hour. So I appreciate everyone coming. And Judd, thanks a lot for presenting. I think it was great information, and we'll see all y'all on the 18th.
Thank you for having me, Craig. I appreciate it. Everyone have a great holiday season. If you don't talk with or see us before then.
All right.
Bye-bye.
Good night.